All right, so we went through a lot of different types of transactions in chapter 3 last week, and we walked through how we can use those T accounts to put together an adjusted trial balance, right? So the first thing we did was we made some journal entries and we worked on formatting those properly with the date and putting a little description at the bottom, putting the debits first and then the credits. And then we took those and painstakingly copied them down into those T accounts, right? So that we could record what the ending balance was. And then once we had the ending balance figured out for all of them, then we copied it from there into an adjusted trial balance format, right? So lots of little mechanical details that we worked on there. If you remember, we had our variety of journal entry examples. If you want to go back and use these as a reference for the different types of transactions that we went through, we have them laid out by category here, what the original entries would have looked like when they were first recorded, what we did to adjust them after the fact, and then at the bottom, we looked it shows an example of an accrued expense or accrued revenue type adjustment. And I know I asked this a few times last week. We talked about how the difference between deferrals and accruals is the timing of the cash flows, right? With deferrals, usually the cash flow happens before the activity. With the accruals, we're usually recording an expense or a revenue, and then the cash flow happens afterwards. So one thing to remember, like if you're trying to differentiate what type of entry you're looking at, is it an original entry or is it an adjusting entry? Adjusting entries will typically not be hitting cash, right? That would be an original entry if you're recording a cash transaction. And then generally speaking, they should at least be hitting either a revenue or an expense account in there. They're not going to be like reclassifications between two assets, for example. So if you look at these adjusting entries, we've got rent expense, we've got depreciation expense, we've got service revenue. So they're hitting an income statement account somewhere in the entry for those adjusting entries. All right. Now, this is what we might see in what's called a general journal. So if we're making a bunch of different adjusting entries in our general journal at the end, we would see a list of all these entries together in one place. And then from there, they would end up in being moved into the ledger accounts, the individual accounts that track the balances for each separate account. So, and that would be the T account that we did last week. So this is an example of the T account. So if you're working on your homework for chapter 3 and you want a one-stop shop to go back and just double check how you're doing your entries, these last couple slides here in the slide deck. So let's see, let me just tell you exactly. This one's like, I started looking at like 50 or so. And then so these last 10 or so slides summarize what happened in the previous like 50 slides. All right, so just as a wrap up there, the adjusted trial balance then is after we've recorded all of our activity for the period, we have an unadjusted trial balance. We make our adjusting entries where we're usually adjusting the balances in some of those short-term asset and liability accounts to what they need to be, and those changes run through our income statement to arrive at the adjusted trial balance. And then we use that adjusted trial balance to prepare our financial statements. So we pull the numbers from that final adjusted trial balance to do our balance sheet and our adjusted income statement. Now, just as like a really quick review then, so let's go back and look at that problem number 3, which someone told me we hadn't done this one yet. So we'll go back and look at this one. They gave us this list of accounts, and I'll keep the list of accounts up here so that y'all don't have to be like going in and out of this window. but we want to assemble the adjusted trial balance. So remembering if we have them out of order like this and we need to organize this into a properly formatted adjusted trial balance, what we want to do is think about our accounting equation to figure out the order that we're going to put these in. So the general order that we want to do is going to be assets first, followed by our liabilities and our equity. And then we want to make sure that we list these just like we would on the financial statement. So we want to start out with current assets. Then we would do the long-term assets up here. And then down here, we would start with current liabilities, followed by long-term liabilities. Then we're going to start out with common stock is usually the first thing, and then any other shareholder stock related accounts like additional paid in capital. And then finally, we would end up with retained earnings. And then, so now we remember retained earnings includes revenues and expenses. So we would do the actual retained earnings account that is on our balance sheet first, and then we would go and do our revenues and expenses after that. So take a minute, work with your partner that's sitting near you, and go ahead and try and identify what these are. We can kind of go through here, and actually we'll do this as a class. All right, we'll kind of go, I'll go by quadrants. So we'll do like the first 3 rows, the next 3 rows. You can pick whether you want to be on that side or that side. We'll do the back 3 rows and then the front 3 rows. And we'll just go around the room and then put the account type here, right? So that everybody can work on this together. So cash, that's probably the easiest one. So y'all are looking at what is that? Asset, liability, what type of account is that? Asset, yep. Okay, please don't mess with people. Hopefully everybody knows that cash is an asset. All right, so back 3 rows. Land, what is that? Asset, right? Okay. Utilities expense. That one. Well, so it could be, remember, it could be one of these down here. So it doesn't have to be, right? So I'll give you a hint on the expense ones should all be expense accounts unless it's unearned expense. That is the one confusing one. Everything else will be under expenses. So those will be down here at the bottom of the list. So that's going to be an expense. Or if it says prepaid expense, that would be another one. Okay, so accounts payable. We're up we're at the front 3 rows here. Asset, liability, equity, revenue, expense. Liability. All right. How about we'll move over here. Accumulated depreciation equipment. This one might be a little tricky. So
contra assets.
Yeah. Ooh, wow. You got the detail on that one. So yes, it would go under our assets. More specifically, it's a contra asset. So I'm just going to label that asset so that anytime we have an accumulated depreciation account, it's going to go right below whatever associated long-term asset account it goes with. So that accumulated depreciation equipment would go right below wherever we plug the equipment because they go together. All right, so then since we did that one, I'll label that one right here. All right, so back of the room, third, salaries expense. Yeah, so equity, but an expense, yeah. Oh, I should put this one for expense so we know. I'll put the sub classifications for the equity ones. And then back of the room over here for supplies expense. Expense, yeah. So whoever gets the expense one sort of wins the lottery unless you get unearned and then you're okay. Common stock. I think we're in the front here. Yeah, equity. So that would be our very first equity account that we would get. Accounts receivable. Yeah. Supplies in the back over there. Back through. Yeah, asset. So utilities payable back over here. Yeah, liability. So that payable is our hint on that one. Service revenue in the front here.
Equity.
Yeah, so equity, but a revenue account. Yeah. And then unearned revenue. Liability, yeah, that's the tricky one because until it's earned, it's not a actual revenue. And then in the back, depreciation expense equipment.
Expense.
Yeah, expense. And then dividends. That's a tricky one. I didn't mention this one up here. This one would be equity, because we're referring to dividends that we're paying out to other people. So that comes out of our retained earnings area. So that would go in this area right here before the revenues and expenses. All right, so with that, so you're going to want to first grab all your assets and put them at the top, starting with cash, and then trying to find them, trying to get them in order of liquidity. So remember, as a quick reminder, liquidity being how close it is to being cash. Cash is the closest thing to cash, so cash goes first. So then we look at how many parts of the earnings cycle something has to go through. So what's the current asset that is the most close to being converted to cash? So cash, yes. So after cash, what's next closest to cash? So accounts receivable, because we've already sold something and we're just literally waiting for them to send us a check. Right? So that'll be our next one. And then if we had inventory, it would be after that, but I don't see that we have any inventory. Okay, whoops, I did that and screwed up the format. Let's move it back. There we go. So for assets, supplies is probably the next one that we have. So I suppose supplies inventory, if you call that. So I think those are the only three current, right? Cash, receivables, and equipment. Oh my gosh, supplies, not equipment. After that, we have our fixed assets, though, long-term assets, yes. So, other assets, we've got equipment and accumulated depreciation equipment and land, yes. So you can put those three. I would probably do equipment before equipment, then accumulated depreciation equipment, and then land would be what I would recommend. And then liabilities, we've got, let's see, accounts payable, utilities payable, unearned revenue. All three of those are current, but accounts payable typically gets listed first. And then utilities payable would be just a hair behind that, just because accounts payable is more general, so we put that first. Utilities payable, I would put into other accruals after that. And then I would do unearned revenue after that, because we have to actually complete an earnings cycle. Whereas with accounts payable and utilities payable, we would have already incurred those expenses. So that's why those would go before the unearned revenue. And then as far as equity goes, we had down here, we wanted to do common stock first. We didn't have any other stock related ones. After that, oh, and then dividends, you'd want to get that in there. So less dividends in there. And then after that, I think it's just revenues and expenses, right? So service revenue would be our revenue, and then did they say anything specific about the order they wanted you to put the expenses in?
They already have them.
Huh?
They already have them in order.
Oh, they already had them in order. Okay. Okay. Oh yeah, you already have your orders. Yes. Okay.
What would we put in the common stock?
You'd So they have a common stock number out here. We have, oh, all right. So then, since there's a question mark there, we would want to use our accounting equation to solve for that one, right? So if we know, let me pull up a little spreadsheet here. Oh, sometimes they let you copy these, put them into. See if this works. Sort of works. Okay, so we'll do this. All right, so if we're sorting these out, then we need to have our assets and we need to have our liabilities and our equity here, and we need to use the accounting equation. So we've got cash of 4,025, land of 5,000, minus accumulated depreciation. I'm just going in order of the list here. I'm not going that the actual order you'd wanted on your trial balance. So I'm just doing this faster to get the numbers on the spreadsheet. And okay, so that's it for assets. So I'm adding that up. I'm coming up with 18,805 of assets. So going through and just grabbing liabilities. All right, so I've got accounts payable. I've got utilities payable, and I've got unearned revenue. So that's it for liabilities. And then for equity, we're gonna have, I'm gonna put the expenses and revenues in here also. So I'm gonna put everything in here. I'm gonna put based on whether they are credits or debits, right? So if I have expenses of 400 and I've got minus 80, and then I've got utilities, I already did that, service revenue, and unearned revenue is in the other, depreciation, and I've got minus 500. So everything that's a debit here, I have listed as a negative. Since liabilities, I have everything listed positively. So let's go ahead and look at this. So if what I have here for these total equals, so let's make sure I've got the 400, 225, 1,000, 550, 80, got the 10,000, that's question mark, 660, 120, 210, 12,000, 300, 800, and okay. So that should be, so my subtotal for these is 10,405. So the difference then between that and that should get me my common stock. So 8,400 is what I'm coming up with for that. Is that what y'all came up with?
Yeah.
Okay, so that should be what you'd get for common stock. Okay. So just to show what that looks like here then. Should be where you ended up. Yep, 8,400 there. And then making sure that you get everything. So you should have your total debits equal your total credits if you put everything in the right columns, right? So debits on the left, credits on the right. Does anyone have any questions on that one? Okay. All right, and then we just had the question 6, correct? Was the other one? Oh, oh, okay. So we did 6, but not 4 and 5. Okay.
We need to finish 6.
Oh, we need to finish 6. Okay. That's right. So for that one, shoot, and I don't have the let's see, so we did the adjusting journal entries and we did the T accounts on that one, right?
Yeah, we still had to do the last part.
Okay, I'm just gonna pull it up, otherwise it's gonna make me enter the stuff in, but we'll walk through what that was. So we got all the entries on that one. And then for requirement 2, we did all of these. I thought we had pulled that in at the end of class, but maybe we ran out of time. Did we not do the adjusted trial balance on that one? Or was there
This one last.
Oh, okay, prepare the virtual worksheet. Yes, okay. So the worksheet part here, yes, and we were like most of the way through the worksheet. Now I remember. Yeah, because we were pulling stuff over. Or am I mixing it up with the previous class? Maybe I'm mixing it up. Okay. So for the worksheet, what ends up happening is just an alternate format of everything that we did here. So let me go out to, I'm gonna actually go back out to the slides here to show you an example worksheet. I can find this here. Where am I? No, okay. I'm sure there was one in here. All right, hold on a second here. Oops. Okay, here we go. So for the worksheet, basically we're doing the exact same accounting process that we did prior to this as far as making adjustments and then coming up with what our adjusted trial balance is. But then we can also use it to separate those columns out into the format of the financial statements that we want to prepare. So it just sort of helps us sort it out. So when we're doing that, this is the format that we see a worksheet in. So we get our unadjusted trial balance, just like we have in our other problems. Only they divide it out into debits and credits, right? And then in this column here, we see the different adjustments that we would have made. So all of the accounts that have debit balances would be on the left column, and then all of the accounts that have the credit balance would be in the right column. And then we can show here the adjusted trial balance, which would equal our unadjusted trial balance with the new balance adjusted for whatever entries we made in the adjustment column. So if we don't have any adjustments for a column, for a particular account, like we see on the cash side here, it was 12,200 and there was nothing in adjustments. We just carry it directly over. So we don't even have to do anything other than transferring it right over. But down here, they had accounts receivable and they had total entries of $800 into accounts receivable for the period. So that's one thing to watch out for on these adjustments. If you have more than one entry that hits a particular account during the period, you want to put the net effect of whatever entries happened for the whole period for your adjustments, right? So here they just have one letter listed. They did entry H for 800. So if you started out with $1,000 debit balance for this accounts receivable here, and then you debited it for 800, then you'd have an $1,800 ending balance, right? So instead of doing this in a T account format, we're kind of doing it in a spreadsheet format with the worksheet. So it's the same exact process, except we're just looking at it in a different orientation. And then once you have all of these totaled out and carried over into your adjusted trial balance column, then you can look at them and say, all right, which financial statement would this go on? Would this go on the income statement? Would this go on the balance sheet? So for income statement, that's super easy because we know that nothing on our balance sheet is going to transfer over onto that income statement. We only need to look at the revenues and expenses. So if we go to the bottom down here, We see here service revenue is the first income statement account. So we carry that over into the credit column. All the expenses get carried over into the debit column over here. So we'd have 17,500 here, and these would get carried over. And then the net of the two would give us our net income for the period. And then the balance sheet accounts would all get carried over up to here. So, so looking at how that would work for this problem, we've already gotten our unadjusted trial balance, and we've gotten our adjusted trial balance. So what we would want to do is just fill out the unadjusted columns, carry down the net of the adjustments from the T accounts that we did up above. So like up here for the, we didn't have any adjustments for cash or payables, but for service revenue, we had two adjustments here, right? We had 3,000 and 1,300. So in the credit column for the adjustments on that worksheet, we would want to total those two up to be 4,300 and put those in the adjustment column for the worksheet. So let me just really quick here. I'm going to just copy this and put it into a spreadsheet so that I can walk you through this. Oh, and it's not putting them into columns. That's annoying. All right. I'll just delete these. All right. So if I was doing this in a worksheet format, I would go through my unadjusted trial balance here, and I would just, oops, it's an error. I'd start off with these balances here, and we want to have a debit column. You have a credit column in yours, right? Does it give you the unadjusted to start off with, or are you having to fill that one in? Huh?
Yeah.
Okay. So then what you all need to do would just be to put in your adjustment column, and then carry over the net of the adjustments to the adjusted column. The advantage you have, since you've already done the adjustments in T accounts, you know what you need to carry over into your adjusted trial balance column already, because we've already actually prepared an adjusted trial balance for this problem. So you can just grab those ending balances off of there and put them into your adjusted column. All right. Or did it pull in all three, or just the which columns did it pull down into the worksheet that it pro-formed for you? Okay, and that's it. Okay, so oops, one column over here. Let's see, common stock was 12. Oh, how did I get off here? Let's see, 4,000, 2,000. Oh, there was no beginning balance in salaries payable. That's why. Okay. Okay. So once we had that, then pulling over our adjustments column, all you're gonna do is go through and grab the net adjustments that we made in these T accounts. So going in order, we didn't have any adjustments for cash, right? So we can leave that blank. Accounts receivable, we had a debit of 1,300. And then supplies, we had a credit of 800. For land, we didn't have anything, or building. Accumulated depreciation building, we had 1,000. Furniture, we didn't have anything. Accumulated depreciation furniture was 2,000. And then accounts payable, salaries payable, we had a credit of 500, right? And then unearned revenue, we had a debit of 3,000. Nothing for common stock or dividends. Service revenue, that was the 4,300 I was just talking about a minute ago. So 1,300 plus 3,000. And then salaries expense, we debited for 500. Supplies expense, we debited for the 800. So all I'm doing is transposing this from the one format into the other format. And then for depreciation expense building, the two depreciations, we had 1,000 and 2,000. And then nothing for advertising. All right, so those are all of our columns there. I'm just gonna go ahead and I'm gonna put subtotals in here so that we can just make sure that we have everything totaled that we need. So I should always have my debits equal my credits if I have everything in here correctly. So I do for my unadjusted, and I do also for my adjustments that we made. My debits are equal to my credits. So I know I've got everything in the right columns. Okay, now.
I have a question about service revenue.
Yep.
There's no place to put the adjusted trial balance.
You should be able to just go like right over. Are you over by one extra column possibly?
Oh, I see.
Oh, did you have to scroll over?
No, it's just there's
Oh, okay. Okay, so once we have that, then we need to do our columns for our adjusted trial balance. So we're gonna again have debits and credits there. I'm just gonna add a little tiny mini extra column there just to differentiate these so we can see the space between, just to help break that up a little bit. Okay, so here, no entry, so we can just copy that over for 6,000. Here we've got debits and debits, 5,000 plus 1,300 equals 6,300. Here we've got it. Now here's where we got to watch closely. All right, we've got $1,000 debit balance to start with, and we've got an $800 credit adjustment, right? So we need to net those against each other. One goes one way, the other one goes the other way. So 1,000 minus the 800 gives us just 200 left. And if you are unsure of what your balance should be, you can scroll back up to the T account for that one up above and look at it. But it's faster if you understand how to work through it on the worksheet side, because then you don't have to be scrolling up and down the whole time. And that also means that you'll help learn what the meaning is behind the worksheet as well. So it'll help you with your fluency as far as that goes. All right, no adjustment to land, no adjustment to building. For accumulated depreciation, we started with 30,000, had 1,000 more, so that gives us 31,000. No adjustment to furniture. Here we had 4,000 and 2,000, both in credit columns, so that's 6,000. No adjustment there. No adjustment. Oh, we had started out with a 0 balance, but then adjusted for 500, so 500 there. Okay, now here we have a credit balance in this column, and then we adjusted it by $3,000 for a debit, right? So 8,000 minus the 3,000 gives us a net of 5,000 at the end. No adjustment here, so we just carry it over. No adjustment. Here we had 2 credit columns, so 60,000 plus 4,300. So 64,300. A debit and a debit here, so adding those together for 16,500. No adjustment, or I'm sorry. We had no beginning balance and just the adjustment, so 800. Same, whoops, go away. There we go. Same thing here, 1,000 and 2,000. And then down here, we had a debit for 3,000 and no adjustments. All right, so now if I total these up, again, my debits equal my credits. So I probably got everything where it needed to be is if my debits and credits are equal. If you add those up and your totals are off, then just check whether you had any that started out with like a debit and had an opposite direction adjustment, because those are probably you added them together instead of netting them against each other. So look for ones where you have combinations of debits and credits between your unadjusted and your adjustments if you find that your totals do not equal from your debit column and your credit column. All right, and then from there, it's just separating them out into your financial statements. So we'll have income statement. I'll make another, oops, I'm going to make a little mini one there again so we can see the difference. And then balance sheet will be over here. So we could just go right from the top and scroll our way down. So 6,000 in the debit column. I'm going to label these again. And then we had 6,300, 200, 10,000, 40,000, and the income statement and balance sheet columns should be easy. You should be able to just kind of carry stuff over. All right. Okay, so accumulated depreciation furniture. Whoops, make sure you go on the other side, because accumulated depreciation is a credit column. And they didn't, I noticed they didn't mess with retained earnings here. If you have a problem where you need to adjust for the retained earnings, then you're going to want to use the retained earnings formula. I'll show you that in just a second. But the dividends is the last account here that is actually on your balance sheet. So then going back to our income statement column for the rest of them, we can copy those into these columns here. Now, when you add these up, you're not going to end up with a balancing balance sheet here without having an income statement line. All right, so they didn't really show this in the slide here because they didn't complete these columns, but you're going to have a note, you're gonna have a line on your balance sheet, worksheet for your income, your net income, that will make that balance for you. So let me find here. I can show you what that looks like actually on the sample problem here. All right, so we've gone through the whole process for the worksheet here, so I'll show you then what that completed worksheet will look like for y'all in your sheet. Okay, so they just had us go through to the adjusted trial balance here. They didn't continue through to the income statements, but all right, let's do that one there. So that's question 6. All right, so has everybody got everything you need for question 6?
No.
No? Okay.
Right.
Okay. All right, so that was anything else anyone needs for this one? I actually did more than we needed to because I showed you the income statement and balance sheet ones, but those will be helpful for you to have. You good?
The balances.
Oh, I'm sorry, what?
The balances. The total. Yeah, you need to check the balances.
Oh, check the balances for,
The totals.
oh, okay, right there. Yep. Sorry. All right. Are everybody good? Okay. All right, so then, whoops,
What did we ever do question 4?
what was that?
What did we ever do question 4?
Okay. Oh, all right, let's see. Yeah, so this is okay, so this is kind of a big brain question, all right? So we're gonna be thinking about what the impacts are for different transactions, all right? So we've got, we wanna figure out if we don't do the adjusting journal entries, what would be the effects on our financial statements, all right? So to figure out what would happen if we didn't do it, we think about what would the entry be that we would need to make, and what does that do? And then if we didn't make it, what would happen? All right, so there's kind of multiple thinking steps that we want to do here. All right, so here we've got a list of adjustments here. The very first one that they want us to look at is we used some supplies for $1,800, all right? So thinking about the entry that we make here, what would be the adjusting entry that we would make? So like just from a theoretical standpoint, we start out with a balance sitting in our supplies asset account, right? Our supplies inventory. We've got that recorded because we recorded the purchase of those supplies, but now we've used some of them up, so we need to make our journal entry, right? So what is the entry that we're going to make there? And you can think about this from an increase and decrease standpoint, because that'll help you with figuring out what the financial statement effects are.
I think we would credit supplies and debit the supplies expenses.
Yep, so we would credit supplies and then we would debit supplies expense. So the supplies inventory account that we would be crediting or reducing, if we don't adjust it, what's wrong with that account? So let's say we bought $1,000 worth of supplies and we use 800, but we haven't recorded that we used those up. How does that affect our inventory account?
It still says you have for 800 or 1,000.
Yeah, so would that be overstated or understated? Overstated, right? So supplies on our balance sheet would be overstated, and supplies isn't those are an asset, right? So we would be, so on our balance sheet, we would have that our supplies are overstated. Oh, nice. They're not even asking whether it's an asset or whatever. Okay, so we've got that. And then on the income statement side, we would not have recorded that supplies expense, right? So what does that do on our income statement then? Yeah, so supplies expense would be understated. All right. Oops, what did I forget here? Oops, it's wanting more here. Let's see. Oh, okay. All right. Yeah. So also then, what does that mean? So they're wanting us to also go further and say, all right, if we didn't record that expense, then what does that mean for our equity? So expenses reduce our equity, right? So if we don't record an expense, then our equity is going to be overstated. And then over here on this side, if we don't record the expense, how does that affect our net income?
That's overstated.
Yeah, also overstated. So the net income being overstated is why our equity would also be overstated. There we go. All right. Okay, so now we've got accrued service revenue. I'll just delete that since it tells us here. Okay, so accrued service revenue of $4,000. All right, so remembering that an accrual, so this is a fancy way of mentioning that we have an accounts receivable sitting out there for $4,000 that has not been recorded, right? So what does that mean for our let's see, how are they categorizing that? So they're talking about so for our receivables, what does that mean if we haven't recorded that accrued service revenue? Understated, yeah. And then that also means then on our income statement, what does that mean? Understated service revenue, right? So then our net income would be what? Understated, yep. And then also that means from an equity standpoint that it would be understated. So if our net income is understated, our equity will go the same way. All right. Okay. And trust me, I totally get that this feels like pulling teeth because it's a very abstract way of working through this, just like doing it all in your head. So if this feels like painful, it's not just you, it's sort of how this process works, unfortunately, just when you're learning it up front, and it gets easier when you've done it more. So you guys are doing really, really well at this, by the way. I have to say, like, very well. Okay, so depreciation on the building was not recorded. So when we record our depreciation, what account are we hitting on our balance sheet?
Assets.
Yeah, it's the contra asset that you mentioned earlier, right? So accumulated depreciation. So if we don't record that, our accumulated depreciation will be what? Understated, because we didn't make an entry to it. All right, so then the flip side of that depreciation entry is depreciation expense, right? So what would be the impact on huh? Oh, did I put making total assets overstated? That's correct. So if we don't record our depreciation, then we would not. So okay, looking at how this works, let me just show you with the so we'd have the fixed asset account for the building, right? So fixed asset building account less our accumulated depreciation gives us our net building book value. So if we don't record this, we don't subtract that amount out, then our overall fixed assets will be overstated because we're not subtracting it from our assets. because this is a contra asset account. So it actually reduces our overall asset balance. So, but accumulated depreciation, that's a credit that gets credited, and then we would debit our depreciation expense. So if we don't record that depreciation expense, then depreciation would be what? Understated, right? And so how does, if we have an expense that's not recorded, how does that affect net income? It's overstated, yep. And then equity is therefore also overstated, yep. Good job, okay. Prepaid insurance expired, like AKA was used up, right? So if we were going to make an entry for prepaid insurance, to adjust the prepaid insurance to show that it was used up, would we would be moving it out of prepaid insurance and into insurance expense, right? That's the entry we would make. So is our prepaid insurance then overstated or understated? Over, because we didn't reduce it down when we used it up. So prepaid insurance is overstated. And then our insurance expense then is what? Under, yeah. All right, so someone from this side in the back, let's do the back quarter over here. I know I'm confident in you guys that you guys can figure this out, or y'all, I should say. So if our insurance expense is understated, how does that affect our net income? So our expenses are low, that would make our income look too what? Too high, yeah, so net income would be overstated. And then let's do the back of the room over there. So our equity would then be what? If net income is overstated, equity is also overstated. Yeah, exactly. Thank you. Oops, what did I do here? Net income is oh, I put net income, equity overstated. Grab the wrong one. There we go. All right, we're on the home stretch. Almost done. Okay, accrued salaries expense of $27.50. So people worked, we incurred the expense, but we did not record that we owe them the money on our balance sheet, right? So we've got salaries payable that we did not record. So salaries payable is, yep, thank you. I saw someone mention salaries payable is understated. So then our salaries expense would also be what? Understated, right? Because we didn't record the expense at all. So salaries expense is understated. Net income is what? Overstated. Yep. Thank you. And then impact on the equity is what? Overstated. Okay. How many? Wait, we've got to be close here. Yeah, all right, this is the last one. I thought the last one was the last one. This one is actually the last one. I'm like the parent in the car that's like, we're almost there. This is a lot of these. Okay, so service revenue that was collected in advance has now been earned $130. Okay, so we recorded this when they paid us $130. And we recorded it at that time, it would have been an unearned revenue because we didn't complete the earnings cycle. So we have this liability sitting out there for unearned revenue. And we did not adjust it. So unearned revenue is what? Overstated on the balance sheet. Yeah. And then that means that our actual revenue is what? Understated. And then, so what does that mean for our net income? Understated, yeah. So if we don't record the revenue, then we will understate our net income, and then our equity will therefore also be understated. Okay. Yay. I feel like that was such a journey. You guys did wonderful. Everybody did great. I appreciate the universal participation. It's a group effort. Okay, that was the last one we had to do, right? For chapter 3?
5.
Oh, I tried to do 5 before and everybody said, no, go do 4. Okay, we could do this one. You know, we just did, let's make this one optional. We just did one exactly like this. We don't need to do this one. We'll skip this one. All right. And if you want to do this one as practice, you can. You won't get marked down if you don't complete this one, because the in-class exercises, they're all like pass fail. So if you did most of it, you get all the points regardless of if you got it. So don't feel compelled like you have to fill this out. But if you're feeling like really compulsive or you want the practice, you're more than welcome to do that one, but you don't have to. All right. So let's go ahead. I don't want to start a chapter when we have 5 minutes left. So if y'all want to do this last one and take a couple minutes and try and do it, you're welcome to do so. Otherwise, we can wrap up on that. Sound good? Okay, and then we'll see everybody on today's Monday, so do Wednesday.